So is Fed Chair Powell going to finally tell us what to make of where the Fed is going next, or are we just going to continue to be scratching our heads for another however many weeks, creating chaos in financial markets? That's the question we ask ourselves today on Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we begin today with quite a bit of economic news flow behind us and no more clarity about exactly how the markets feel about policy, but at the same time, no shortage of volatility around their evolving views. And so as Fed Chair Powell takes the podium here in the next 24 hours at the Economic Club of New York, there is certainly quite a lot to answer for. There is a clear desire amongst financial market participants to have more clarity, to have a better roadmap. And the MO of the Fed has been that perhaps there isn't one. We are going to try to unpick exactly what's going on here, get a sense of what the markets are doing in response, and then see how whatever the Fed chair might clear up here or not is going to influence the price action in stocks and bonds and currencies and in commodities. So let's begin with a bit of stage setting here. We start with the very clear assessment that the markets are being pointedly driven by Fed policy expectations. Of this, there seems little doubt. Because what we see as a clear trajectory going from about the middle of the year is a pointed cutting of rate cut expectations for the tail end of this year and next. We can see it in stark relief on the chart that you have in front of you here. The gray bars are expectations for cumulative moves in the Fed funds rate as they are priced into Fed funds futures between November of this year, which is the next Fed policy meeting. We have a pair of them left, one in November, one in December. So what we're looking at here is the cumulative impact of policy for those two meetings through all of what happens next year. So through all of the meetings that the Fed holds next year, February through December. They typically don't have a meeting in January. So what we're looking at here is the reduction of net cut expectations by 2/3. So the markets are expecting about 180 basis points in easing as of late June going into July. This, of course, reflects the remnants of concern about the banking crisis, the remnants of concern about the debt ceiling debacle. And what we see thereafter is a normalizing away from that. And you can very clearly see that as you get into late July and all of this is digested, stock markets turn a corner and start to head lower. So here is this digestion period right here. This is about where the peak in rate cut odds occurs. You can see the absolute peak is right here on this spike, but right here is essentially where the floor on cuts emerges. And as it emerges and those cut expectations begin to get pulled in, stock markets turn. They continue to head lower as these cut expectations are reduced. And what we are looking at now is a mere 60 basis points in cuts. So we've cut this by 2/3. As a response, not surprisingly, the stock market has declined because the proposition being made by Fed policy expectations as they're evolving here is that interest rates will exact a higher cost of borrowing on all economic activity for longer than markets anticipated before the shift. Meaning it will be more expensive to finance economic growth of any stripe and of any kind for a longer period of time. This is the higher for longer thing that everybody is throwing around constantly. You can see it clear as day right here. Fast forward to the most recent set of market moving releases, and we see that there is some kind of a evolution that's occurring, and it is not clear which way that evolution is taking us. Let's begin with the September 20th FOMC, which you can see here very clearly marks a downturn in markets. From that FOMC, you get a pointed decline in the S&P 500 as a kind of avatar for overall market mood. It begins on the day of. It is unmistakable. So what occurs? The Fed comes out, releases its summary of economic projections, maintains the outlook for rates for this year unchanged, but pointedly increases the outlook for rates next year. Even as it maintains inflation expectations relatively steady, it reduces the outlook for unemployment. It increases the outlook for growth. So the Fed is saying the economy is going to grow faster. Unemployment is going to be lower than expected. That will make for a tighter economy than we thought. We're going to have higher rates. The market, not surprisingly, does not like this in an environment where global growth is already near standstill. We have at this stage already the latest round of PMI data showing us that at 50.5, composite global manufacturing and service sector growth is but half an index point away from standstill. In the logic of PMIs, 50 is standstill, above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. We can clearly see here that at the start of this year, the service sector was on the way higher. That orange line you see there was going up and further above 50, implying both growth and acceleration in the growth. We can see that started to peak, rolled over right about mid-year, and is now receding to a point where global growth is all but stopped. Needless to say, it's very difficult to come to a consensus on fiscal stimulus at a local level. Witness the debates in the U.S. Congress at the moment. But coming together to a fiscal consensus on an international level is, absent a crisis like COVID, almost impossible. On the monetary side, though, things get much simpler because the Fed is essentially the one-stop shop for shaping global borrowing costs. With close to 80% of all monetary transactions settled in U.S. dollars, what matters for global borrowing is the cost of borrowing a specific currency, dollars, because that is the thing you need to lubricate virtually any kind of economic activity, ultimately. And so what the Fed does in increasing and decreasing the cost of borrowing dollars influences the cost of capital worldwide and makes for a single point of action to help to countervail this growth decline. It's a single actor. It's much easier to get a policy response that is potent and powerful from that single-minded actor than it is from a cacophony of fiscal side policymakers, even locally, never mind international. So the market is understandably saying, if the Fed is going to keep interest rates restrictive at a time when global recession is in view, that's a bad thing. And if the Fed is going to give us a bit of a reprieve by starting to pull back on interest rates, that's a good thing. We can see from that September 20th meeting, the bond market clearly respond to the idea that the Fed is saying, we might not necessarily hike more, but we're going to stay higher for longer. Longer-term bond yields rise. Near-term bond yields, the 2-year yield remains anchored, signaling the Fed is probably done hiking, but they're probably not cutting in a hurry. And so the response ends up being greater uncertainty in bond markets about how all of this is going to meet when higher interest rates clash with a recessionary environment. And so the premium on time, the term premium in the Treasury market here in the yellow bars, increases. What that's saying is investors perceive greater risk in lending for longer periods of time because they perceive greater uncertainty the more time is allowed to elapse. All of which suggests the markets see the intersection of what the Fed is trying to do and the reality in market growth dynamics and global business cycle dynamics as clashing with some degree of fireworks, or at least a meaningful risk of those fireworks. And so, not surprisingly, the response is stocks go down. More uncertainty is not a good thing for markets. It's about the one thing markets hate more than anything. Stocks go down, things settle. Then we get, shortly thereafter, September's jobs report that comes out on the 6th of October. And the dynamic begins to change. When we get those numbers, we get an outcome meaningfully better than expected. 336,000 jobs added against expectations of 170K. That extends a 3-month run of improving jobs growth, which, of course, from the perspective of the Fed, might have been judged as something that delays rate cuts. Because if the labor market is still hot, then inflation is still trapped in it by way of sticky wages. And this is precisely the mission that the Fed has been on, addressing that issue. Cooling the labor market such that sticky inflation locked in wages that were negotiated and locked in during the height of labor shortages post-COVID are squeezed out, and that inflation is squeezed out with them. In this case, through layoffs. So we get this strong jobs number, and you might think, well, the market will be more worried that the Fed holds interest rates higher for longer, not less. This should be a negative thing for markets. And indeed, the entire week going into this data, a bunch of leading labor market numbers exhibited exactly that dynamic. Where ADP was weak, it was a bit supportive. Where ISM was strong on the labor and the job side, it hurt. So too did the JOLTS job openings numbers. And so you get this sense that this is the kind of set of data that might unnerve markets. And initially it does. But then you get a quick rethink and a very demonstrative display of laissez-faire. So here comes the jobs report. It gives the response from the S&P that you might expect. This is a chart of ES futures. And then the market pointedly reverses, as if to say, we're done pricing in higher for longer Fed policy odds. It's now baked in. This is no longer a market mover. Still more evidence comes as over that weekend you get the breakout of the travesty now taking place in Israel in its conflict with Hamas. The market gaps lower at the initial risk, considers the implications of what this conflict is going to mean for the global macroeconomy, and shrugs it off. In a matter of hours, closes that gap. What do we see thereafter? Markets begin to recover, signaling seemingly in an unmistakable fashion, okay, whatever the Fed surprised us with here was fully priced in on the way down to here. Now that it's priced in, it's over. Over at least for 6 days. Because, of course, on the 12th, you get the CPI number, and things change again. What happened there? We get a narrowly higher than expected headline CPI number. The core number actually comes in spot on with expectations at 4.1%. The core here is ostensibly what the Fed cares about. This is what captures those things that the Fed can have agency over. And of course, most critically, the service sector, where that labor market inflation is baked in. But the headline, that includes food, that includes energy, and is subject to the vagaries of what happens in those markets internationally. Fed doesn't have very much to do there at all, and they are relatively minor influences on inflation at this point. We can see food inflation is relatively modest as a contributor here. Energy has become less negative of a contributor, but inflationary it is not. The biggest deal is services. But the markets don't appear to care. They look at this 3.7 number. They see that it's higher than the 3.6 number that's expected. And there's a reaction. Now, here's the breakdown of what actually occurs, just to illustrate the point. The majority, overwhelmingly, of why this is a positive surprise here, month on month, why inflation narrowly ticked up from August to September, isn't what happened at core. There was disinflation there. Isn't what happened in the Fed's most critical part of the story, the service sector. It's energy, because energy became less negative of a contributor. Still a negative contributor, as you can see here, but less of one, because energy prices went up. So the surprise at headline here, ostensibly not the most Fed relevant kind of thing. Yet here's the response. On the basis of that number, stocks go down. And just earlier this week, we get a stronger than anticipated retail sales number, and it happens again. And so when we look at this kind of thing, we say, well, clearly, if we thought that here the markets stopped caring about a higher for longer Fed, here it seems to have started to care about it again. Despite the fact that the internals of the economic data would seem to suggest that there isn't necessarily a reason to be all that concerned. But the price action cannot be ignored and is unmistakable. Here's the current policy curve as it presents itself in the solid line there. The small dashes are where that curve was a week ago, meaningfully flatter. You can see it's steepened significantly. The big dashes are where the curve was on the Fed's meeting on the 20th, at the end of that day, once the market kind of settled after the Fed's speechifying and release making. And we can see that here the situation is a little bit muddier when we get to the 6-month, the 1-year outlook window. But ultimately, there's no question that this also is a steepening of the ultimate curve. We land at rates well north of 4% toward the end of the outlook in the current view, which is much more hawkish than it was after the Fed made its announcement and even just a week ago. You can see that difference right here, 2 years out and 3 years out. So higher for longer is really showing up here. If we look at what this is going to translate to as policy expectations, we can see that we're looking at barely any chance of a rate hike at this coming meeting, just 5.7% right here. But the odds of one in December, non-negligible, 37%. That's quite a bit higher than a meager 20% just days ago. The cumulative likelihood is 55% that you get some kind of a hike by January. So that's adding these together. So if you don't get a hike in November, there's a further 37% chance that you get it in December. If you don't get it then, there's a further 13% chance that it occurs by January, and that's that cumulative 55, 56 right here. What that's telling us is that the market now sees narrowly better than even odds of one more hike. That's a very significant departure from what the markets thought even a week ago, where the likelihood was only about 30% of another hike over this time. And so you look at this and you notice a pointedly more hawkish perspective. The timing for the eventual rate cut has been pushed out. We're now looking at one rate cut fully baked in come September. A week ago, it was July. Not too long ago, it was June. The rate prevalent at the end of next year, seen at 4.8. That's a good 20 or so basis points higher than the average of about 4.6 that has prevailed for weeks, if not months, give or take. And so the markets are clearly looking at the news flow here, onboarding it, and saying, this means the Fed might actually be even longer in its delay for when we see these cuts. And then there's the flip side. This is a relatively new indicator from JP Morgan. And what it does is it analyzes Fed speeches and scores them for hawkishness or dovishness, and then constructs an index. This, of course, is extremely helpful because what you can very clearly see here is how Fed commentary sets the stage for what the markets then begin to do. You can see that Fed speaking is dovish since the beginning of the year, or is growing more dovish. Shock of shocks, of course. This is the banking crisis. This is the debt ceiling debacle. Not surprising at all here, one might think, that Fed rhetoric leans in the direction of we need to support this economy if there is some kind of a crisis that spills out into the broader credit structure out of all of this. Where do things bottom? Well, right around end of May to the end of June, where all of these things get ostensibly pushed to the back burner. There's a deal on the debt ceiling. There are Fed actions to contain the banking crisis contagion, and things calm down, and things begin to normalize. Notice where the bulk of that is taking us. This is now becoming more hawkish. And of course, what do we know occurs there? This. The timing could not be aligned any better. The top in stocks is carved out in late June going into July, just as Fed rhetoric starts to become more hawkish. There's a very clear reaction function here. There is then a sharp turn on September the 20th here with that Fed policy announcement, as you might surmise. Because again, as we can see here, there is a very clear turn in markets that occurs at that point. And what we see is that even as the markets digest what the Fed is telling them, the actual rhetoric couching that adjustment starts becoming more dovish and really starts to gain momentum in October here. All of which is to say, Fed officials are becoming less combative. We saw this from a whole variety of policymakers in recent weeks, basically assessing that we probably don't need any more hikes, that the Fed can pause here. Now, a pause does not mean that rate cuts are imminent, but it is the prerequisite to rate cuts. And so the markets are understandably looking to see what Fed Chair Powell is going to say about this now, because clearly they've been back and forth on this incessantly, where Fed officials are now saying, well, maybe there's not any more hiking that's necessary. The markets seem to be broadly in that camp. Although, again, there is now a 56% chance that there is another hike by January. That's perhaps a little bit unnerving. And so they are looking perhaps for the Fed to indeed be signaling accordingly. But the markets have also clearly been motivated by the degree of easing that comes next and the timing for that easing. And that has been a move away from where the markets want to go. So what the Fed is going to say here through the avatar of Jay Powell will be tremendously important. Now, if the Fed chair endorses the idea that rate hikes are probably over, there is perhaps a degree of respite that the markets can find there. Again, we can see here there is a better than even chance, even very narrowly, that there is another rate hike on the menu. If that can be driven back down, even though the Fed chair is unlikely to be perfectly transparent or pre-commit, if it seems like he's going to endorse this recent commentary that's been a little bit less combative and suggest that indeed we are getting to a place here where maybe rate cuts don't need to continue, that will probably cheer markets. But what it won't do is give much solace on where things go from there and how soon rate cuts can come to alleviate these concerns about global recession. And there, the markets want clarity because they're clearly jumping from release to release and changing their mind quickly as they try to read the tea leaves of what the Fed is thinking and what it's going to do next, even at the cost of perhaps overreacting to a CPI data point that didn't quite have all the meat that hawkish speculators were looking for, and that, of course, didn't prevent them from shaping outcomes whatsoever. If the Fed chair is noncommittal there and maintains a kind of neutral, we'll see how it goes, it's a meeting by meeting sort of thing, well, then what the markets are left with is continued uncertainty. And that uncertainty may be a risk-off catalyst onto itself, where investors essentially say, you know what, this is too stressful. It's impossible to figure out what's going on here. And the markets are clearly so jumpy in the face of changing expectations from release to release, from data point to data point, speech to speech, that there's just too much volatility. Let's just back up. Let's liquidate and step back and let this dust settle before commitments are made. And so the Fed chair need not necessarily talk down rate cuts, only to give no indication that they're any closer or that the Fed is any sooner in its thinking about when they arrive. And that non-commitment by itself may well be a reason for the US dollar to find some support in markets cashing out, for shares to find their way lower, and for the markets to generally turn sour on riskier sort of assets like cyclical currencies, for example, the Canadian or the Australian dollar, or cyclical commodities like copper or even crude oil. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio, head of futures and Forex here at Tasty Live. And we're increasingly joined by the great Dylan Radigan for that conversation as we try to figure out what happened on Wall Street on a given day and what that might mean going forward. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and occasionally opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading out there. Macro Money will be back tomorrow. See you then.